Hey guys, what's up? I'm Erin and welcome back to the channel. When it comes to retirement, one of the most important questions to get right is how much can you safely withdraw from your portfolio without running out of money? There is no shortage of resources out there that attempt to answer this question, and that really can feel overwhelming. So I'm going to try to walk through a few of these side by side so you can decide what's right for you. And honestly, I believe this is one of the most important pieces of the retirement puzzle to get right. Spending in a way that allows you to maximize everything you've worked so hard for over the decades, while still giving yourself security and peace of mind that your money is going to last throughout the course of your entire retirement. And really, this is the balance we're all after. Morningstar's latest research has suggested that a safe withdrawal rate might be around 3.7%. That means if you had a $500,000 portfolio, you'd start your first year of retirement by withdrawing $18,500. And then increasing your withdrawal amount by inflation each and every year. It's simple, it's conservative, but it's not the only approach. What if instead of sticking to this 3.7% adjusted by inflation every single year, what if you were comfortable with pausing your inflationary hikes following the year where the market was down? Well, then they suggest your rate of withdrawal could safely be 4.2%. You're getting to start at a slightly higher withdrawal rate, but there is nuance here. Your withdrawals are fairly steady, but you're showing restraint. In the years where the market performs poorly, you don't adjust for inflation. You don't give yourself an increase. By holding off increasing your withdrawal following a bad year, you give your portfolio more of a chance to recover. And if you're willing to exercise this type of restraint, you get to start with a higher income without introducing more risk to your portfolio. And then there's the most flexible option, a guardrails approach, which allows you to begin retirement with a withdrawal rate as high as 5.1%. Guardrails means you're actively responding to market conditions. The good news is, if the market performance is strong, you get a raise in your retirement paycheck. And more good news here, the market is up way more often than it's down. History shows us that the market is up 74 to 75% of the time. But the trade-off is you also have to be willing to cut back on your spending when the market is performing poorly. So this approach isn't for everyone. The good news is that most of the time you are enjoying a spending increase, but you have to be adaptable and you have to be willing to spend less following the years where the market has a downturn. So in this video, I want to walk through these three different frameworks, starting with a withdrawal of 3.7%, giving yourself an annual inflation adjustment, starting with a withdrawal of 4.2% and giving yourself conditional inflation adjustments, assuming the market performance is favorable, and not giving yourself an inflation adjustment when the market performs poorly, and a guardrails approach, starting with a withdrawal rate of 5.1%, but you're willing to adapt your spending up or down based on the market's performance. Let's look at the type of income they provide and the trade-offs that come with each approach. All of these withdrawal rate models are based on a portfolio that holds somewhere between 20 and 60% in equities. Morningstar's research found that the higher your exposure to equity, the higher the chance of failure with a portfolio due to higher rates of volatility. So to have a portfolio that fits within this model from Morningstar, we're going to go pretty simple. 50% in equities, 50% in intermediate bonds. And again, just for the sake of simplicity, I'm going to use a two-fund portfolio. We're going to use Vanguard's VFIAX, which tracks the S&P 500, representing our equity side, and BIV, an intermediate term bond ETF, representing our bond allocation. We'll run this portfolio from 2007 through 2024. I would have loved to run this experiment going back a full 20 years, but unfortunately, I couldn't find the data for BIV for the years 2005 or 2006, so 2007 is our starting year. Here's what the performance of that 50-50 portfolio would have looked like year by year over that time frame. And we can see that this portfolio really does smooth out the ride for a retiree. Take 2008 as an example. Equities were down nearly 37%, but bonds were up almost 8%. The result was a blended portfolio decline of only 14 or 15%. That's still painful, but it's far more manageable than being fully exposed to the stock market. With a more balanced portfolio, you don't capture 100% of the upside during the bull market, but you also don't absorb 100% of the downside during bear markets. The trade-off is exactly what makes this kind of allocation so useful in retirement. Now, your reaction to this type of 50-50 portfolio really depends on your preference for risk tolerance and your preference for portfolio construction. But I'm using this portfolio because it aligns with Morningstar's research. It's also worth noting that once many people enter into retirement, they have a portfolio that tilts more to the conservative side of the spectrum. And the reason is simple: stability. Lower volatility means less surprises in the short run, and that can be a good thing when you're counting on drawing money from your portfolio. For a lot of people, going into retirement is shifting your mindset from a growth mindset to a preservation mindset. It's about knowing that your money is going to be there when you need it. Let's start with Morningstar's baseline, a 3.7% starting withdrawal in year one, then increase that dollar amount each year by inflation. This is the most conservative of the approaches we'll cover. And to keep things simple, we are going to keep the assumptions the same for each model that we walk through, and we're going to keep it pretty straightforward. We'll have a $500,000 portfolio, 50-50 split between VFIAX for equities and BIV for intermediate term bonds. We'll also assume that our retiree has a Social Security benefit of $1,100 a month starting in 2007, which comes to $13,200 per year. This was the average retirement benefit at the time. We will also apply Social Security cost of living adjustments each year going forward. The portfolio withdrawals will layer on top of this. In year one, the portfolio withdrawal starts at $18,500. Combined with Social Security, that gives us an annual income of $31,700. By 2024, after years of inflation adjustments, the portfolio draw increases to just over $28,000, and Social Security has now grown to just under $20,000 through cost of living adjustments. So the total income for the year is now just over $48,000. So let's break it down. From 2007 through 2024, the total Social Security benefits received was just under $285,000. The total portfolio withdrawals was just under $400,000. Combined over this time period, this gave a retiree an income total of around $684,000, and their portfolio ending balance by 2024 was just under $700,000. This fixed real approach really aims to preserve your purchasing power in real terms by keeping pace with inflation. But there is a trade-off here. We have a smaller starting paycheck and a smaller check going through the years because we're not willing to be flexible with our approach. But in exchange, you get simplicity, predictability, and a high emphasis on durability of the plan. Now let's look at a flexible but still simple variation. You start with a withdrawal rate of 4.2% in year one, then only give yourself an inflation raise after years when the portfolio didn't lose money. If the prior year was negative, you skip the raise. You don't cut your spending, you essentially just stay flat. And this pause hopefully gives your portfolio a moment to breathe and a chance to recover before you increase your withdrawals. So this approach really adds a little bit of flexibility, but it keeps the plan still pretty darn simple. Again, we have all the same exact assumptions as before. A $500,000 portfolio, 50-50 split, and Social Security amounts are exactly the same. In the first year, we get a portfolio withdrawal of $21,000. Combine that with our Social Security benefit, and this gives us an annual income of $34,200. By 2024, with conditional raises over time, the portfolio withdrawal is now over $29,000. And Social Security benefit is the same as our previous example, just under $20,000. So our total income for that year is $49,000. during this period with this withdrawal style, our portfolio withdrawals came to $446,000. Combine that with Social Security, and now we had a combined income during this period of $730,000. Our portfolio ending balance in this case was just over $600,000. This conditional inflation approach allows you to start with a higher withdrawal rate, 4.2% versus 3.7%, but it's still a simple plan to follow with a rule that allows you to avoid any spending cuts. You just simply skip the raise after a year where the market performed poorly. In return, your income path is a little bit less smooth than the fixed real approach, but you do get to start with a higher income in retirement. You have a higher income throughout your retirement years, but you do end with a smaller portfolio balance. Your income in retirement has less variability than a guardrails method, so maybe this is a great middle ground for those who want to introduce a little bit of variability to their income, but they still want a fairly steady paycheck. Finally, let's look at the most flexible option. You get to start with a withdrawal rate of 5.1% in year one, and then adjust your spending using guardrails. In this version, we'll put our guardrails at plus or minus 10% of the scheduled inflation-adjusted withdrawal. In plain English, you're going to give yourself a raise when the market performs well, and you're going to cut back your spending a bit when the market performs poorly. It's a rules-based way to respond to market conditions. We'll put the assumptions here on the screen, but they're exactly the same as before. The same portfolio, the same Social Security benefits. In year one, the portfolio withdrawal was $25,500. Combine that with Social Security, and we had a household income of almost $39,000. Fast forward to 2024, after years of inflation moves and guardrail adjustments, the portfolio withdrawal is over $36,000. And Social Security, that's around $20,000 following cost of living adjustments. So we have a household income of about $56,000 for that year. Altogether, the total portfolio withdrawals in this situation are about $484,000. Combine that with Social Security received during this time period, and this retiree's total income for this time period was about $768,000. Their ending portfolio balance at the end of 2024 was just $526,000. The guardrails approach delivers the highest starting paycheck of all of the methods, and you get to enjoy greater spending power because remember, the market is up far more often than it is down. There is a trade-off though, more variable cash flow. There's also a greater need for discipline, for being willing to cut your spending when the market performs poorly. And you'll also notice that we end with a portfolio that has a lower balance than if you had used a more conservative withdrawal rate, and that's to be expected. So ask yourself this: what matters more, maximizing lifestyle today or preserving a larger legacy for tomorrow? Your answer will help to guide you on what your withdrawal strategy should be. For retirees who want a larger paycheck, who want more spending power in retirement, the guardrails approach can be a great way to make sure you get to spend the most while having a little bit of flexibility on how you spend it and still ensuring that you preserve your portfolio. Let's talk about how income actually fluctuates in the guardrails approach. Yes, your withdrawal can move within the guardrails themselves, but that does not translate into wild total income swings because remember, you likely have non-portfolio income sources like Social Security in this example, and Social Security or other income sources would act as a stabilizer. Take 2018 from our guardrails example. Our portfolio withdrawal dropped by over 8%. However, once we factor in Social Security, the total income for the household only reduced by 5% for the year. Social Security clearly softened the blow. That's really the key point. Guardrails create real, rules-based adjustments, but Social Security stabilizes the paycheck so the changes feel noticeable but not drastic. It's a way to respond to the market while keeping your income livable year to year. And the more income sources you have that are not coming from your portfolio, the more stability you'll have. Now let's do a comparison across all strategies. As you look at this table, you'll notice the Social Security line is identical across every single method. It doesn't change just because your withdrawal method changes. It provides a meaningful and steady base of income. Now, most retirees do tend to spend less as they age, and if this happens, you get to dial back your withdrawals. This puts less pressure on your investments, but Social Security, that keeps showing up every single month like clockwork, and this creates a really strong base, and this allows you to have confidence. So let's look at the total incomes with these different withdrawal strategies. 3.7% fixed real, we have total income spending in retirement of $684,000. For the 4.2 conditional inflation approach, $730,000. For the 5.1% guardrails approach, $768,000. So the guardrails approach delivers more spending power, roughly $84,000 more than the conservative 3.7% plan, and about $38,000 more than the 4.2% plan. But there is a trade-off. The ending balance is lower. It's around $526,000 with the guardrails versus $693,000 with the 3.7% plan, or around $600,000 with the 4.2% plan. So again, it really comes down to what matters most to you. Do you want higher spending power in your retirement years, or do you want to preserve a larger legacy to pass on? It doesn't have a right or wrong answer, just the one that resonates with you. Let's zoom out for a minute and also look at the average annual income that was provided by each portfolio when we combine Social Security and the portfolio draw. With the 3.7% fixed real approach, the average income was close to $38,000 a year. With the 4.2% conditional inflation approach, it was $40,600. And with the 5.1% guardrails approach, it was closer to $43,000 as an average income. So moving from 3.7 to 4.2 adds about $2,600 per year. And stepping up to the guardrails approach adds closer to $4,700 per year versus the conservative baseline. I really like to spell out these approaches in as many ways as possible and as clearly as possible so that you can make the best decision for you. So at the end of the day, you could really say that this is a values-based decision. Do you want to spend more income in retirement, or do you want to preserve more of your portfolio to pass on to your heirs? Again, there's no right answer. It's just the one that you want to stick with. But once you choose one, write it down, make sure you rebalance on an annual basis, adjust if you are following a plan that allows for adjustments, whether that's guardrails, whether that's an inflation adjustment, whether that's a conditional inflation adjustment. There's no right method. There's the one that resonates with you. Stress test your plan against bad markets, keep your non-portfolio income steady, and let the rules do the heavy lifting. Do that, and you're going to give yourself your best shot at enjoying your retirement today and protecting yourself for tomorrow. So what do you think is the best approach? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Inevitably, a misspeak happens, but the good news is I get about 10,000 people who tell me when I misspeak. So I think of it as a way to keep you humble, you know? You don't want to get a big head, so make a mistake publicly in front of tens, if not 100,000 people. They'll let you know, keeps you in check. I appreciate it. It's Friday. Somebody's gonna come cut their lawn. Oh, that reminds me, I've got to fill out my electric rebate. I own the smallest house on the block, and I was telling my friend about it when she came to see it, and she's like, your home is very Erin Talks Money, and nothing is a greater compliment. Like, this is truly who I am. I love this. This makes me so happy. Hi, how's it going, bud? Come on in. Come on in. Come here. Hi. What makes your life so rough? What makes your life so rough? People miss you. They miss seeing you on the couch in the background.